Napoleon inherited a bankrupt state. Without a modern central bank, his empire relied on forced.
Napoleon Bonaparte assumed power over a state whose fiscal foundations had been systematically dismantled by revolution. The ancien regime system of royal credit, tax farming, and privileged exemptions had collapsed after 1789, leaving behind administrative disintegration rather than reform. By the time Napoleon emerged as first consul in 1799, France faced chronic revenue shortfalls, depreciated paper money, unpaid armies, and creditors unwilling to lend to any government lacking stability or continuity. The revolutionary state had survived through emergency measures rather than durable institutions, and Napoleon inherited both its territorial ambitions and its financial fragility. The central constraint confronting the new regime was the absence of a credible mechanism for long-term public finance. France did not possess a modern central bank capable of underwriting sovereign borrowing at scale, nor did it command deep domestic capital markets comparable to those available to Britain. The Banque de France, established in 1800, functioned primarily as a commercial institution serving elite merchants and the state's short-term needs. It did not operate as a lender of last resort or as an engine for sustained public debt issuance. This institutional limitation forced the Napoleonic state to rely on immediate revenue extraction rather than deferred finance. Napoleon's response was administrative consolidation rather than financial innovation. Under the supervision of Finance Minister Martin-Michel Charles Gaudin, the regime rebuilt tax collection through centralized bureaucratic control, standardization of assessments, and suppression of local resistance. Direct taxes on land and property were stabilized, indirect taxes were cautiously reintroduced, and expenditure was tightly monitored. These measures restored basic solvency but did not generate surplus capacity sufficient to fund prolonged continental warfare. The fiscal system could sustain the state, but not an empire. The strategic solution lay beyond France's borders. Military expansion became not only a political project, but a fiscal instrument. Victorious campaigns produced indemnities, forced loans, and material seizures from defeated states. Northern Italy, the German territories, and later Spain and Prussia were incorporated into a system of extraction designed to finance ongoing operations. Satellite states were compelled to maintain French garrisons, supply troops, and remit payments directly to Paris. These transfers substituted for domestic borrowing and allowed Napoleon to avoid confronting the structural weakness of French capital markets. This model reshaped the relationship between warfare and finance. Instead of borrowing against future taxation, the Napoleonic state monetized conquest in real time. Armies were sustained through requisitions, local levies, and compulsory contributions, minimizing immediate pressure on the metropolitan budget. The approach favored rapid expansion and rewarded continuous victory, but it also embedded financial dependence on territorial control. The empire's solvency became inseparable from its military momentum. Decision-making authority within this system was highly centralized. Napoleon personally oversaw fiscal priorities, treating financial administration as an extension of strategic command. Ministers operated within narrow parameters, tasked with execution rather than design. The absence of autonomous financial institutions meant that no countervailing authority could moderate risk accumulation or impose long-term discipline. Fiscal policy followed the logic of campaign planning rather than economic sustainability. By reconstructing state authority without reconstructing credit, Napoleon built an empire on extraction rather than accumulation. The foundations of his fiscal order were functional under expansionary conditions, but inherently brittle. The system assumed continuous access to external resources and administrative compliance across diverse territories. It solved the immediate problem of insolvency while deferring the deeper problem of institutional capacity. The consequences of this choice would only become visible once expansion slowed and the costs of occupation exceeded the revenues it generated. As Napoleon's territorial control expanded, fiscal extraction evolved from an emergency expedient into a systemic architecture of imperial finance. The empire functioned as a composite of jurisdictions bound less by institutional integration than by enforced contribution. Revenue flowed not through harmonized taxation or shared credit mechanisms, but through coercive transfers calibrated to military presence. This structure allowed France to sustain large armies without fundamentally transforming its domestic financial system. But it also imposed escalating administrative and political costs. At the core of this model were indemnities imposed on defeated powers. The treaties of Luneville and Pressburg obligated Austria to deliver substantial payments, while Prussia's defeat in 1806 resulted in indemnities that burdened its treasury for years. These sums were not merely punitive, they were budgetary inputs anticipated by French planners. Contributions were scheduled, enforced, and when delayed, supplemented by seizures of customs revenues or state assets. The imperial treasury increasingly treated foreign states as balance sheet extensions rather than autonomous polities. Satellite regimes institutionalized this arrangement. The Kingdom of Italy, the Confederation of the Rhine, the Kingdom of Naples, and later the Duchy of Warsaw were compelled to finance French troops stationed on their soil. Local administrations collected taxes that never entered their own fiscal circuits, instead servicing French military requirements. Joseph Bonaparte in Spain and Jérôme Bonaparte in Westphalia presided over states whose revenues were structurally insufficient to meet imposed obligations, forcing them into chronic deficit and popular resistance. These regimes existed to transmit resources upward, not to stabilize governance locally. The continental system further integrated fiscal and strategic objectives. By attempting to exclude British trade from Europe, Napoleon sought both to weaken Britain's revenue base and to redirect continental commerce through channels controlled by French authority. In practice, enforcement proved uneven. Smuggling proliferated, customs officials were bribed or overwhelmed, and economic disruption reduced taxable activity across Allied territories. Rather than generating predictable revenue, the system introduced volatility and eroded the productive base upon which extraction depended. Administrative strain intensified as expansion continued. The logistics of requisitioning supplies across vast territories required constant military oversight, blurring the boundary between fiscal administration and occupation. Armies became mobile tax collectors, but their presence provoked resistance that raised security costs and reduced net yield. Spain exemplified this dynamic. The Peninsular War transformed a potential revenue source into a fiscal sink, consuming men and material while producing little extractable surplus. The empire's financial logic, optimized for rapid victory, proved ill-suited to prolonged insurgency. Key decision-makers recognized these pressures but lacked alternatives. Gaudin and his successors could refine collection methods but could not manufacture credit markets or political trust overnight. The Banque de France expanded note issuance cautiously, constrained by fears of inflation and institutional fragility. Long-term borrowing remained limited, leaving the state exposed to revenue shocks from military setbacks. Fiscal flexibility existed only insofar as conquest continued to deliver returns. By the late 1800s, the empire's financial system exhibited signs of saturation. Each new territory required administrative supervision, military occupation, and political management, reducing marginal fiscal gains. The balance between extraction and control shifted unfavorably. What had functioned as a substitute for public finance now demanded increasing expenditure to sustain itself. The imperial economy became a closed loop of coercion, in which resources were consumed to maintain the mechanisms of extraction that supplied them. This structural tension would define the empire's vulnerability once expansion stalled and losses accumulated. The Napoleonic fiscal system unraveled not through sudden collapse, but through cumulative exhaustion. Its architecture, designed to operate without deep credit markets or autonomous financial institutions, depended on continuous territorial expansion and administrative compliance. Once these conditions eroded, the system offered no internal stabilizers. Military defeat did not merely reduce revenue, it directly dismantled the mechanisms through which the state financed itself. The campaigns after 1809 marked a decisive shift in the balance between extraction and cost. Austria's defeat in 1809 yielded indemnities, but the margin between receipts and expenditures narrowed. The maintenance of occupying forces, subsidies to dependent regimes, and escalating logistical demands absorbed much of the transferred wealth. The Russian campaign of 1812 exposed the structural limits of requisition-based finance. Vast distances, hostile populations, and deliberate scorched earth policies rendered extraction impossible at scale. The army's destruction eliminated both a military instrument and a fiscal one. Without troops, there was no extraction. Without extraction, there was no means to replace the troops. As territories slipped from French control, revenue vanished faster than administrative capacity could adjust. The imperial budget had never been designed to operate within a reduced geographic footprint. Unlike states reliant on bonded debt, France could not smooth losses over time through borrowing. Each defeat translated immediately into cash shortfalls, supply crises, and unpaid obligations. The Banque de France, still constrained in scope and mandate, could not compensate for the sudden disappearance of external transfers. Monetary expansion remained limited, reflecting lingering fears of revolutionary inflation. The collapse of satellite states accelerated the process. Prussia's reformers, including Karl von Stein and Karl August von Hardenberg, dismantled indemnity mechanisms and rebuilt fiscal sovereignty. In Spain, the French administrative apparatus disintegrated under sustained resistance. In Germany, the Confederation of the Rhine unraveled as member states recalibrated allegiance in response to shifting military realities. These political realignments were also fiscal ruptures, severing revenue flows that had substituted for domestic credit. Decision-making under these conditions became reactive. Napoleon continued to prioritize military solutions to fiscal problems, seeking decisive engagements that could restore extraction capacity. This approach reflected the internal logic of the system he had built. Without institutional alternatives, strategic victory remained the only available fiscal reform. Defeat, conversely, offered no compensatory mechanism. The empire's financial structure magnified reversals, translating battlefield losses directly into insolvency risks. The long-term consequences extended beyond Napoleon's abdication. Post-Napoleonic France adopted a more cautious fiscal posture, emphasizing balanced budgets and limited borrowing. European states absorbed the lesson that conquest-based finance produced rapid gains but systemic fragility. Britain's contrasting model, anchored in a central bank and deep capital markets, demonstrated greater resilience under prolonged warfare. The comparison shaped 19th century debates over public debt, institutional credibility, and the relationship between military power and financial architecture. Napoleon's empire illustrated a fundamental constraint of political economy. States can substitute extraction for credit only temporarily. When administrative reach, political legitimacy, and military dominance align, such systems function with efficiency. When any component weakens, the entire structure destabilizes. The Napoleonic experience left a durable imprint on European statecraft, clarifying the limits of empire financed without institutions capable of absorbing loss, delay, and uncertainty.